Let's move on to our next segment, which is Wrap the Week. On every Friday, what we love to do is just take a step back and see how things were evolved. I just wanted to start with a poll we asked of you recently. We always have polls running on the StockCharts TV page or elsewhere where you see our content. We asked you recently this week, which asset class do you think will perform best over the next 3 months? And I gave you three choices: rocks, scissors, or paper. Rocks meaning gold, precious metals, hard assets. Scissors meaning bonds. That's a reference to clipping coupons of your bond certificates. And then paper assets in the form of stocks, the S&P 500. It was almost a 50-50 split between stocks with 47% of the vote, gold with 44% of the vote, and bonds not getting a ton of love. Only 9% of you said that was the best option for the next 3 months. So what's interesting is if you think about what that means, we're all sort of keyed into, how I would interpret, how I would summarize that is stocks are in a solid uptrend, but at significant resistance. Gold is in a significant uptrend, has pulled back in the last week. Bonds have been in a decent uptrend, but there's certainly an expectation of limited upside there, more so than in those other assets where you could conceivably see them getting materially higher years down the road, right? I mean, I think there's a case to be made that gold, has a multi-year uptrend, for example, or it ends, 2025 higher than it is today. And I think with stocks, you could make that case as well, looking at historical bull and bear cycles. With bonds, that's a tough sell just with how low rates are. So if that's what people were saying with their answers, I think I could see it. If you asked me to vote on this one, I'd go with rocks. I'd say gold, and I'd say that only because when I'm looking at a chart of the S&P 500, the signs I'm seeing now are a strong trend that is nearing the latter phases, and there's limited upside based on how far stocks have run up until now, where I feel like gold and silver certainly have potential for further upside. But again, I can't disagree with both of those from a purely technical perspective. You're picking two assets in pretty strong uptrends. Let's get to our Wrap the Week segment in a little more detail. I wanted to start with this chart, which just takes the close from last Friday and takes it to where we closed today. Sort of fluctuated there at the end, so sorry if the labels are a little off, but this will sort of orient you to where we're at. The S&P 500 here finished the week around 0.8% higher than it did on last Friday, the 14th. Two asset classes have outperformed equities this week. Bonds in the form of the TLT up almost 2%. The big winner is the NASDAQ 100. This is up 3.5%. This is the form of the Qs. In terms of what underperformed stocks this week, the dollar essentially finished the week perfectly flat, right around 0%. Gold down 0.25%, crude oil down 0.5%, Bitcoin down a little bit more. Small caps, the big laggard, down 1.6%. So this chart is a helpful one that I like to review on Fridays just to sort of see week to week what's happened and just make sure that I understand the movements. But I think this relationship from the biggest winner to the biggest loser sort of shows you the story of the market this week. And I think more broadly, the story of the markets as the S&P approaches this key line in the sand of 3,400. Technology, the technology-heavy NASDAQ, up 3.5% this week. Small caps down 1.6% this week. So in that same week, and just look at the course of the week, it was just a strong leadership from tech, communication, services types of stocks, consistent underperformance from small caps. That's sort of what this market feels like. The average stock is sort of flat to down, I would say, or certainly not appreciating meaningfully, but there's a small subset of stocks that are doing very, very well, and that's what's holding up this index. When you see the S&P testing 3,400 again, that doesn't mean the average stock is doing particularly well in this week, or that it is a broad advance around 3,400. I would argue that if small caps were up here somewhere, the S&P would be much higher than that, because I would tell you it was a much broader advance. People were spreading their bets across a lot of different names as opposed to going to the relative safety of some of these mega cap tech stocks that have done so well up until now. Let's dig a little deeper into it. I just want to show very quickly what's happened today, and then we'll get into some of the longer term charts. So very, very quickly, in case you missed it, mid caps down, small caps down even more today, down 0.6%. You can see the gap down out of the open. The VIX just around 22. Looking at bonds, finished up today 0.6% with the TLT rallying, and the US dollar up 0.5%. This is after a stretch of being essentially relatively weak. Looking at commodities, gold and silver down today. This after yesterday, really finishing stronger going into the close. It felt like that might be the beginning of further upside, not to be though, and the commodity complex overall up 1%. Tech really led today, followed by consumer discretionary. After that, sort of a rounding error above zero. On the downside, energy continuing to struggle on a relative basis, followed by materials and communication services, not usually at the bottom of the list here, but making an appearance here today. In terms of key movers, I mean, just a couple of things very quickly to highlight. Marriott in the top 10 today, and hotels overall have been struggling. You can see it in the little preview chart. Actually, I'll jump into it a little bit. You can see how hotels have been coming off over the last 2 weeks, really. The relative strength has come down as well. It sort of rallied in the last day or two, potentially indicating the beginning of a higher low. You can see that HLT Hilton is in there as well. Maybe looks a little more constructive. You're testing the 200-day moving average. I think that's a key group to be watching to see if they're able to improve here. That's a group that I think a lot of people have sort of mentally written off. Then on the downside, Regeneron's probably the most concerning chart I'm seeing on here. This has the feeling of a bit of a rounded top. And over the weekend when I do my run of the S&P 500 names, I'm sure I'll spend some time thinking about these biotech charts, because they certainly seem to have transitioned from a sideways trend to more of a downtrend, especially on a relative basis, making a new 6-month relative low today. So an interesting potential development right about there. Let's pivot to the Mindful Investor live chart list. This is the way that I love to sort of start at the top, and I think of macro analysis in 3 phases. Price as most important, breadth as second to that, and sentiment as third in priority. All 3 of those are important, but that's the order of priority that I tend to assign it. Number 1 is price, and let's start right there. The S&P market trend, as we've talked about, no change here really. It's been fairly consistent the last couple weeks. The long-term trend is driven off of the 21 and 34-week exponential moving averages. That's the blue and red lines there at the top. And the purple histogram gives you the difference between those two. And that's the essence of the PPO indicator, the percent price oscillator, which is very similar to MACD if you're not familiar with it. This turned bullish in early June and has remained bullish through this week. The medium-term trend, by my estimation, is the weekly PPO using the traditional settings, 12, 26, and 9. And that's the green and the red lines that you see here. It turned positive here in early May and has remained positive through this week as well. As a quick proxy for the short-term trend, and usually I'm looking at the daily chart to get more of a short-term read, but in terms of 3 pieces on one chart, I'll look at the weekly PPO and just look at the change in the histogram. We've been down the last couple weeks, which is why I say short-term bearish. And I think what that is picking up on is the slowdown in the trend as we've approached this key resistance level. You can see when you use the spiders and use the adjusted data, we are already above that February peak. The S&P 500 just looking purely at the price level, not quite able to get that much above. It has traded above and made a new 52-week, new all-time closing highs. That's totally fair, but not really able to follow through much beyond that. Here's a daily chart of the S&P. In my base case, I've mentioned, I think, every day this week, so I won't belabor it. But overall, the blue shaded area here on this chart is the 3,200 to 3,250 area. That's the peak from early June. That was the retest, the low in late July. And from there, we've returned to the previous highs. I think my base assumption is that we'll get a pullback around to those levels. That's the 50-day moving average as well. I think that's a safe downside bet with minimal pain for anybody. I think that's a reasonable expectation. If you're long-term bullish, for sure, I think that would be more helpful than anything. The question is what happens at that point, and if we follow through and make a new swing low, at which point I think you have to start reconsidering long positions and look at where your bets are, or this could be a fantastic opportunity to load into there. And I think the red line here at the bottom indicates that bearish divergence that we've seen. Anytime you see higher highs and weaker momentum, doesn't tend to be encouraging about long-term appreciation from this current point. Next one is looking at breadth. So now we've talked about the price clearly in an uptrend, I think facing huge resistance. That's sort of the main assumption there. When we look at breadth, a couple different ways we're gonna slice it. But here we're looking at the cumulative advanced decline lines. This is not updated through today's close just yet. So we'll see that over the weekend, or later tonight. But overall, I just think if you look at the course of the last 5 trading days, you can see what's a bit concerning from a short-term breadth perspective. The S&P has gone to a new closing high, or certainly threatening a new closing high with unable, no follow through yet, but trying to do so. But look at how the breadth has turned down across the board in the last week. So what that indicates is even though the index is appreciating and the index is holding up there on a price basis, a small number of huge cap names can do that. If the average stock is rolling over, this is what will happen. If you look back at major tops in history, that's usually what happens. Small caps and mid caps will struggle first. They'll start to roll over, and you can see that the breadth on small caps much more painful than the breadth change in the S&P 500 because it's the more cap weighted to the more geared toward the mega cap, means it's going to hold up a little bit better because those have been really the leadership here. Today it was large cap growth leading the way and small cap value the worst out of all of them, I would assume. So that's why the breadth has turned negative. So while not a wholesale long-term, this is the end, we need to get super defensive, it's certainly lining up with historical market tops and showing you weakening breadth as we approach a previous high. That's pretty classic looking at breadth over time. You've also seen a bit of a drying up of new highs and new lows. Again, this is not updated for today yet, so this is through yesterday's close, but you can see this week, there have been at times a decent number of new highs, so it's skewed because of such a low level there in March, but at times 10% of the S&P was making a new high. We're not seeing that. We're actually seeing less and less every time the S&P gets to new highs. Over half of the S&P 500 remains above their 200-day moving average, just below 60%. That's still pretty healthy. As long as that remains above 50%, that's sort of the characteristic of a bull market environment. If we would break down through 50%, I will be the first to tell you about it and to indicate some potential issue. Pivoting now to sentiment, no real change in the AAII survey. Similar numbers of bulls and bears to last week. Bit of a narrowing between the two, but not much. And so overall, I think it can remain sort of an unloved bull market making new highs, but limited bullishness relative to previous highs is a noteworthy lack of euphoria that you would often associate with market tops. Just very quickly, want to finish up by showing that semiconductors have rolled over on a relative basis. That's one thing I'm certainly looking at. And small caps, while they started the month of August pretty well, have now rotated back down. And you're getting this cyclical pattern of outperformance and underperformance of small cap versus large. Certainly something to be paying attention to, especially as the S&P, again, is trying to make new highs. You'd want this line to be turning higher, I think, to feel good about potential upside from current levels.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.